What's up, everybody? Welcome to Mackey's Retail Roundup Live. I am Spencer Israel from Stock Market TV. That's Jeff Macke from Mackey's Retail Roundup. Today, we're talking about a couple things. We're going to start off the video. We're going to talk about Foot Locker. They just got acquired by Dick's Sporting Goods, and there are a lot of implications for that. And then at the end, we'll talk a little bit about Walmart. They're in the news, tariffs, price increases, the White House. A lot going on there.
A good vigorous scolding. It's exciting stuff. Things are popping, Spencer. Let's get into it.
Little presidential scolding. All right, but first, Foot Locker. If you missed the news, Dick's Sporting Goods is buying Foot Locker for about $2.4 billion. This news broke the week before that we're doing this video, so last week. And why you ask? Is Dick's acquiring Foot Locker? They're going to drive long-term success through innovative store concepts and digital experiences, Mr. Macke. If you are a shareholder of Foot Locker, you have a choice. You will either receive $24 per share in cash, or you can have your Foot Locker shares converted to shares of Dick's Sporting Goods at a ratio of 1 Foot Locker share to 0.1168 share of Dick's Sporting Goods. So that's if you're a Foot Locker shareholder. Let's talk about the implications, though, for Foot Locker as a business. Mr. Macke, you were, as soon as this happened, your first thought was this is bad news bears for Foot Locker as far as the business goes. Explain why.
As far as the long-term employees go, it's all the platitudes aside. You basically kind of regurgitated the McKinsey "we're here to create synergies" playbook of corporate acquisition there, and that's the best they could come up with. My friend Lauren Thomas broke this story over at the Journal. Dick's kind of swooped in there, and we've talked about this with a lot of these retailers. They're beaten down so far that really, honestly, what should Foot Locker shareholders take? I would take the cash and I would tithe accordingly. You can see they got quite a little Hail Mary here at the end with that 100% premium. A lot of chatter about how much of a premium that is, but it really just takes them back to December pricing. Foot Locker kind of had to sell. They are in the middle of a turnaround that wasn't going any great shakes. They pre-announced a lousy quarter. The best time to do that is when you're announcing a 100% premium takeover offer. But they were going to run out of cash. There was a very real risk that we were going to have a lot of out of work people in referee jerseys. Nobody wanted that. So if you're if you're a Foot Locker shareholder, congratulations. You're a Dick shareholder. Yeah, we'll see how this works out.
So Foot Locker shareholders, they got bailed out, right?
They got bailed out, and what happened with Foot Locker were a few different things. It was really this is yet another situation where the kind of tariff burp that we put into the system, the supply chain hiccup, Foot Locker wasn't really playing with a lot of slack to kind of deal with. You can see that's a chart of Foot Locker and Nike. 60% of everything Foot Locker sells is Nike. So Nike's been on the schneid lately. It's really hard for Foot Locker under the best of circumstances to turn around. The Foot Locker, the way they were going to turn around before was to really have Nike do a lot of the design work on Foot Locker stores, which gets them even further to bed with one vendor. It was not a great kind of situation for them, and it wasn't looking like it was going to turn around fast. Even Nike themselves, whatever you think of current management, they're not going to really have product in the channel for about another 8 months that guy even has much to do with. So they're a rebuilding process, and they just ran out of time over the last few years. That's a chart of Dick's and Foot Locker in terms of the amount of cash they're generating. That's the amount of cash flow. That spot in the middle there is COVID. Okay. So when COVID hit, one of two things happened. Companies either got really much better at just what they do for a living, and that's Dick's with the green line, started generating cash. They increased their online operations. They did stuff like make it so you can order and go pick up product. Foot Locker went kind of rear guard. And so now you have in Foot Locker a store that has only 10% of their sales are online. So almost no e-commerce presence whatsoever. A cash flow problem and entirely dependent on Nike, which is not quite the deal that it used to be. So these chains have really taken different directions. That's why Dick's was in a position, it was anywhere near apparent that in 2020, Dick's would be the buyer in this situation. But, they're getting a reasonable price. We'll see. I'm not sure.
Why exactly is this bad for Foot Locker as far as the business goes?
As far as what the workers are doing, because listen, if you pull up that longer term chart of Foot Locker again, it was public for about 60 years. It kind of from the cradle to grave type of story. That's just a 5-year chart. This thing was down from over $50, $60 in a pretty much a straight line down to 10. Now you can see some spikes along the way. We brought in the Ulta CEO. She was going to fix the place. That didn't work out so great. I just don't think the future of selling shoes and athletic apparel is going to be some guy in a ref jersey that disappears into the storeroom for 20 minutes at a time. And that's the business model Foot Locker had. And it's really hard to turn around. Now, they do have a bunch of international stores. And we did see with Dick's a few weeks ago when they reported they've got tremendous cash flows, but it's not really clear they know what to do with them. So, that's quite a Hail Mary. That's Foot Locker over the course of the company. As you can see, people, they worry about me when other specialty goes down. Spencer, I will never ride a specialty retailer stock into the ground. Not ever. It's where love goes to die. All of them die eventually. Foot Locker had a hell of a run, but as you can see, it basically went out just about where it went public, 40 years ago, 50 years ago. So they had a nice run. Congratulations, Foot Locker, and to you shareholders.
What is Dick's going to do to Foot Locker as a business?
What they're going to try to do originally anyway is they'll take over sort of the remodel of the chain. Dick's is working their own experience type of, you go into the batting cage, you hit the golf balls, you do all that type of stuff. The biggest advantage that they're going to have in terms of how this works synergy wise, if they really want to explore ways to make this more valuable, they have to decrease the reliance on Nike. What Dick's has is the ability through being they are now officially the biggest of big dogs in the kids and athletic footwear world. And so, they're going to be able to get better terms, and they're going to have less of the Nike product that's just kind of garbage for them on the shelves. For instance, with the Foot Locker deal with Nike, before this buy went through, they were going to remodel the Foot Locker stores, but they were going to use much of them as a place that they could display Jordan brand apparel, which is really kind of a slow growth idea of brands that Nike's been trying to jam down people's throats for 25 years. It's only about a $2 billion business. It was all going to be at Foot Locker. Dick's will undo that and kind of revise the stores in a more sensible way. But in terms of distribution systems, online operations, everything technical that would create jobs, man, this is a downsizing story. So far, Dick says they'll find 125 million in savings. It'll be probably closer to 5.
So then, if you're Dick's, why are you doing this deal?
They're out of better ideas, and I think that they just saw an opportunity. It can decrease their reliance on Nike and sporting goods. It gives them a different place to go. They've really kind of dominated that big box space. They were out of ideas. When they were on their last conference call, they said, we're going to make even bigger stores, almost theme parks. That was not necessarily, that's a step into the great unknown. Just like Callaway Golf did, right? When they decided to go become a driving range company. No one wants to see Dick's Sporting Goods become an adventure park. So, this gets them into malls. It gets them more shoe space. It allows them with vendors as if they didn't have enough authority already, but they're really going to be able to dictate terms, which is why the assumption that's going to be so great for Nike, we'll see. It's, and I get in here, it's, if they stay just as they are, the new Dick's will be about 40% Nike, all in, but they're not going to have to. What they're going to do is they're going to continue to give better brands and better opportunities, higher margin goods like On's, Hoka's. That's going to be the winner here. They're going to try to soup up the Foot Locker e-commerce, get rid of Jordan clothing, and Dick's goes global. They're going to become an international player. So it's super ambitious. It's 10% of the Dick's market cap. It makes the stock, it raises a lot of questions. As you know, I love the idea of Dick's Sporting Goods. I think it's absolutely just iconic American company. This is an aggressive step, and you're not going to get hurt kind of waiting for it to play out a little bit.
So just to be clear, how do you feel about this from a Dick's Sporting Goods point of view?
I think it's a little aggressive. I think they could have waited. I mean, if you pull up that long-term Foot Locker chart, you're playing chicken with zero, right? It's your other buyer is going to be maybe Nike, but it is a decent chance that you can come back and buy Foot Locker for half the price in a year. Yeah, there's nothing really that's going to happen there. They've got kind of 0% comps. They're entirely dependent on Nike, a turnaround that even Nike doesn't think is going to happen that fast. So things are a little ugly.
Didn't Nike also? Oh no, it was Foot Locker, not Nike. It was Foot Locker that stopped playing ball with Nike a little bit, right? Where they got Nike off some of their shelves, right? Wasn't that a thing?
Yeah, coming to a business case study story near you. The Nike's wanted to be a retailer forever. And a few years ago, under the guy who's the CEO now, he lost a power struggle to take over. And the guy who won, he got Nike out of the stores. Part of that was necessary because they just had so much product scattered to the winds. But part of it was so they could build those huge, elaborate Nike stores that they like so much. Turns out Nike is not a really good retailer. So that didn't work out that well. They lost a lot of share. The new guy's coming in and he's really playing ball with the vendors. He gives shout outs. Nike calls are famous for talking about Serena Williams and Roger Federer. Now the calls talk about Dick's Sporting Goods executives and other people who sell their stores. They're giving shout outs to the shoe buyer at Nordstrom's and stuff. It's a different way of doing business.
It was Nike who turned the cold shoulder to Foot Locker, and now they've gone back on that. And
they're getting desperate. I mean, Nike really had this idea that we're just going to capture the entire value chain. And they saw a world where everybody bought everything online. And it turns out you need to try shoes on once in a while. And, Nike made these big kind of antiseptic stores that didn't go that well. So they would be the other bidder for this. It would have been they don't have the juice to buy them anymore. But that would have been a more interesting fit with Nike and Foot Locker.
All right, let's talk about the implications here for other companies that are still public, like On Holding, or ticker On. We call it On because that's the ticker. What does this mean for a company like them?
The immediate assumption was that this was going to be great for Nike, right? Because out of business Foot Locker was going to be a disaster. Foot Locker was never really going out of business. But what this deal is going to do, On and Deck, which they own the Hokas, they've been taking share like crazy at Foot Locker and at Dick's especially, because they're just simply higher margin products for those retailers. And so On Holdings, they're going to do much better from this. They're going to they'll have international exposure immediately, a huger footprint, and just be in a lot more doors, as they call them, pretty much immediately. And they're small enough at only $2 billion revenue that this matters. And so this is another maybe $500 million type of orders that you can see really easily over the next couple of years. And both On and Hoka have grown from about mid-single digits to low double digits market or percentage of sales at Foot Locker and Dick's over the last couple of years. So they're going to continue to do that. I mean, Dick's is now the 900-pound gorilla of shoe buyers.
Wait, so why exactly are they going to be increasing share here?
It's because they offer the higher margin product. When the situation with Foot Locker and Nike before was that Foot Locker was essentially taking any product that Nike would give it because they were doing 60% of the sales and they were keeping them in business.
Now they don't have to, right?
Now they don't have to. Now Dick's doesn't need to take any guff from anybody. They're going to go with the higher margin business. Even as it was, you saw again, Foot Locker was giving up share on the highest end because Nike just doesn't have really competitive running shoes at this exact point. Like the highest end stuff is taking share at full prices. As On said in their conference call, we're a full price vendor, which is just crazy. That means we're not taking any markdowns. We don't have to. Nike can't say the same.
So maybe fewer Nikes and more Ons and Hokas at Dick's Sporting Goods. But what about Victoria's Secret? They don't make shoes.
They don't make shoes, but you know what? It's the animal spirits are cooking. We saw again, Skechers got bought. Foot Locker got bought. Those are two shoe industries, but those are the kind of bets that you see made when the more patient money, the private equity guys or the acquiring corporations, they can kind of see past the next couple quarters and they can start getting long. Victoria's Secret's launched a poison pill today. This stock's already 50% off the lows in the last month. I mean, absolutely making just absolute bank. But only now did someone come forward and they took more than a 5% stake, making Victoria's Secret come up and get a poison pill. Now, if you look at, there's the 50% run in 1 month. That makes it look expensive. But if you go up to the chart that we just saw, over the last year, Victoria's Secret is fine. It's up 5%. So it's really not an expensive stock. It's 10 times earnings. It's still an acquisition candidate. And again, you're playing on the scenario, not that all the shoemakers are going to get bought. That's the wrong way to look at this. You're looking at companies that, like Victoria's Secret's, were just beaten absolutely mercilessly on the idea that we're going to the deepest of all recessions and that you really had frozen the supply chain entirely. Well, now they're back in business and they're cheap. And if you can convince management to sell at these levels, At least Dick's thought it was a good deal. The guys who bought Skechers thought it was a good deal. There's just people out there that are willing to spend money and start betting on these retailers, and they're cheap. A lot of really cheap retailers out there.
Such as maybe Kohl's or Under Armour or Best Buy or Callaway, maybe.
I would love Callaway. Again, Callaway's bounced from the lows. That's another one where they really had terrible news, and they could use a deal. I mean, they're just trying to get out of Topgolf so very hard, but it does make it hard to short right now in any of these environments. Macy's has nothing going on from a retail perspective. That stock's been on fire. You don't have to buy all these things, and you can go bankrupt really fast buying retailers, just hoping that there's a buyout in play. But it definitely puts a floor underneath some of these players that you're seeing out there. Some of these earnings reports that we're going to see towards the end of this week, when Gap reports, some of the other companies that get out there. American Eagle, they missed. It was a disaster, but someone can come in and buy them. They're a $2 billion company, and they're a pretty compelling offer because just on a cash flow basis, now that the stocks have been folded in half.
So obviously in the case of Foot Locker, they get acquired by a much larger retailer, Dick's Sporting Goods, but how many, there aren't that many large retailers that can go around snatching up Victoria's Secret or snatching up Under Armour, right? So
it'll be private equity groups. There are a lot of guys like, there's not Toad Bravo necessarily. In this case, they're more of a tech operation, but Texas Pacific Group, there's the Simon Property Group was doing buyouts before when COVID happened. There's plenty of people that can make a more efficient go of it with a lot of these companies. And there was Foot Locker, you can say what you will about it. They were in no danger of explosive upside growth anytime soon, but they're not going out of business. Victoria's Secrets, we talked about it before, not great margins, but they're cash flow positive. They have great space in the mall, and it's a pretty lucrative space, again, barring just a global catastrophe or a huge supply chain freeze. And so right now the stock's just beaten down because we still have kind of unknown tariff risk. If you're Texas Pacific Group, it's simply worth more to you as a non-public company than it is to put up with shareholders every single quarter asking when you're going to turn around. And your answer is, I don't know, what's the tariff do today?
Yeah. So it's the we're not going out of business model / argument. Cash flow positive, real business, real revenue. And you're right. A lot of these companies are probably better off as private companies. So
I think Skechers is the best example of that, right? Where we have an 85-year-old billionaire that's running that thing. And he's just, it's a perfectly fine company. He's had a great run. They offered him $1.1 billion for his personal stake. I think, you're offering that to just these companies. He's looking at 6 months of just nothing but headaches. His stock has already been folded in half. We'll hear what Decker has to say later this week. But, it's who needs the headache. It's in these super thin margin businesses. It's really hard to look past economic turmoil, unless, of course, now that you pull them up, you're someone like Walmart.
Let's talk about that. So Walmart has been in the news. They reported earnings last week. They said, as most people probably expected, yes, these tariffs are going to impact our business. We are going to have to raise prices to make up our margins. And turns out people don't like it when you do that, Jeff.
I mean, yeah, which is just kind of the economics 101. Walmart came out, they drew two lines on a little board. They said one's called supply, one's called demand, and they intersect, and that's price. And the price goes up when you create a 20% higher. And all of a sudden they're getting heckled. Pull down to the president. The president immediately goes off on them. Tells them that what should happen is Walmart should eat the tariffs. They got to eat the tariffs, which is an interesting visual, and not charge value customers anything because he's going to be watching all 300,000 SKUs that Walmart sells. I mean, maybe we'll see. As you can see, I've got them squaring off there. It'd be an iconic battle. Come get Netflix. Another reason to be long Netflix. But, that was the follow-up is Walmart had the temerity to say that, when you raise our costs by 25%, it's probably going to trickle through to consumer on some level. Now, all they really meant was, they're Walmart. They love to keep prices low. It's really their entire gimmick. So they're not going to make it super transparent. They're not going to put it on price tags. They threaten nothing of this sort. But obviously, prices are going to go higher. It's not going to be on the obvious things, but everything in the store comes up a couple pennies. I was at a Walmart over the last weekend, which that most people that we talk to can't say that because I just go to Walmart's over weekends. the place looked great, but it also did not look like a lot of price gouging going on. It was reasonably priced stuff there. It's if you can get a $10 T-shirt in 2025, it's I don't think there's a lot of price gouging going on. It's 4.5% margin business, so it's a weird fight for the president to pick. But we'll see. I guess Walmart's easier to pick on than Apple.
But bottom line, you still thought it was, that's true. You still thought it was a very good report from them. Political stuff notwithstanding, you like
it was note perfect. It was note perfect. It's controversy kind of comes for all these retailers at some point. I forget how many groups are boycotting Target this exact day, but it's probably 10, 11, and it's from the best intentions for them. But really, Walmart said what they had to do, which is we're going to be fine. We can handle this. It's Walmart grinds their suppliers all the time. And so believe me, if anyone's going to be jamming sort of the tariff down their people's throats, it's going to be Walmart, who negotiates famously hard with everyone that sells product in their stores. They admitted to economic truth. Sure enough, you and I were laughing. Home Depot reports this morning, and immediately, really without even being asked, the first thing they say is, what we're not going to do? We're not going to raise prices because of tariffs. Just apropos of nothing, Spencer. You just thought that maybe that would be something that they would just like to mention, that maybe Home Depot is a little more patriotic than that. Maybe they just give a crap about John Q. Public and the price of nails, Spencer. Maybe that's who they are. It's your plywood.
It's chef's kiss. Beautiful.
You will not hear one other company. It's so chastened. Say what you will, and you don't want to be in the headlines getting crap from people about raising your prices recklessly and having them eyeballing you. Even if you're Walmart, it's Walmart's they're the largest private employer. They have like 1.2 million Americans on the payrolls. The president's not going to screw with them too much, but Walmart's going to respect that. They're going to give a wide berth as well. So Home Depot, the second largest retailer, one of them in the country, immediately just that became the angle. We'll see if Target can pull it off with a straight face, because the idea that Target's not going to have to raise some prices is a little laughable. We'll see if they kind of mumble that during the call on Thursday, or how they circumvent the wrath of the president with the various protest groups. Because right now, everybody's protesting Target already. So immediately they'll be boycotting Target again if they raise prices. They really can't win.
Oh, it's so. I sympathize, but it is kind of funny from an outsider's perspective. Seeing, I'm sure all these executives are like, as if our job isn't hard enough. Now we have to navigate a potential political bomb from the White House, right? Nobody wants to deal with that. So,
Walmart is perfect. There's a reason these guys make top dollar, and part of it is their ability to communicate with Wall Street. Walmart is absolutely fantastic at it. There's a reason they trade for 40 times earnings. It's because we believe in the management. They're super smart guys. But you're exactly right. It didn't see that mine. It's very atypical that Walmart will kind of say something that blows up in their face that way. But we live in sort of weird times. But the other thing that's interesting about it's people are short Walmart. Smart people I know are short Walmart, just based on multiples, just based on it being expensive. They reported, they mentioned raising prices. Some of the traders kind of got the narrative right away. They took it from 98 to 92 or something like that. Turned out to be held to buy at 92 because it's, I guess, raising prices isn't necessarily a bad thing. To the point you alluded to earlier, if your prices if your costs go higher, you should increase your revenue a little, and that way you get to make margins and keep the lights on. So having pricing power isn't the worst thing in the world. I'm sure Walmart's going to be fine. It was a beautiful report. It set the bar high. 4% comps is going to be a tough bogey. TJ Maxx, Target reporting tomorrow. But you put it together, and as we talk about over and over again, you start to get a narrative. We got Williams-Sonoma, we got Gap later this week. I think kind of what Home Depot said, it wasn't a great quarter, another quarter that was kind of squishy this morning, but it was good enough. They said people are doing small projects. When Williams-Sonoma reports next week, or later this week, actually, I'm kind of liking that stock. Yet another one, here's another stock 50% off has retraced about 50% of what it lost, and now kind of stuck in that netherland. But Home Depot said that they're seeing a little bit of an uptick. And interestingly, we haven't really seen any type of slowdown yet as these companies report. The 90-day pause that we finally did get was just enough. And as we talked about in real time, and as makes sense, Americans hoard. So, a lot of these companies brought in a lot of inventory early. It's going to make for some kind of sloppy earnings reports. But so far, Wall Street's looking past it, and the stocks are doing just fine. Another big week for the XRT this week.
All right, we'll be talking more about these earnings reports. We're going live tomorrow, Jeff. We're doing this through the retail portion of the earnings season. We'll go live. We'll talk about some of the reports that have just happened, some of the reports that are about to come out. And so that'll be tomorrow right here on Stock Market TV. If you want to get Jeff's free content, he publishes notes every single week, several times throughout the week, talking about a lot of the things that we just discussed, right? The link to sign up for his free report is in the description. And then below that, if you want to actually find out what Jeff owns, what is in his portfolio, what he's buying, what he's selling, get Macke's Retail Roundup. That link is also in the description below. And Jeff, thanks for this. And I'm looking forward to doing this again tomorrow.
Yeah, it's a big time of year, Spencer. I'm looking forward to it as well, man. We'll see you.
All right.